Well, distress can mean a crisis, but it can also represent an opportunity. My next guest sees chances to make money out there, from the suburbs of Beijing to the parking lot of Yankee Stadium. We're joined by David Barse. He's president and CEO of Third Avenue Management. Barse has spent 2 decades investing in distressed assets and previously had a career in bankruptcy and corporate law. David, thanks for coming in.
Thanks for having me, Julie.
So I do want to start with Chinese real estate, because obviously it's gotten such a bad rap. There was a cover story on the in the Wall Street Journal today, again talking about the bubble, especially in residential real estate.
Right.
So when you look at what's going on there, and you've got all this bad talk, I mean, how do you figure out if there's any value?
You know, we try and do the same thing across our portfolio, whether we're in mainland China, Hong Kong, Asia, or the United States, and that's just look at an individual security and dig deep into that individual security and then try and find value. And the beauty for the way we manage money is we're opportunistic and we'll go anywhere in the globe. We happen to think right now, and it's conviction weighted, that Hong Kong property stocks are the best values that you can find. And the reason for that is the stocks that we're buying are blue chips, they're tremendous balance sheets, and they're making investments not just in Hong Kong but in the mainland China with a long track record of successful development projects. So what you read about in today's Wall Street Journal is sort of a macro look at the residential real estate market, and they really aren't talking about the specific securities that we own in our portfolio.
Okay, so let's talk about those specific securities, and let's start with Henderson Land. Well, it's Henderson Land and Cheung Kong are the 2 companies. How are their portfolios weighted in terms of residential versus commercial? Where geographically are they? Tell us a little bit about it.
Right, so there's 2 things that are important for me to emphasize. One is they're not just real estate companies. They're sort of conglomerates, if you will, because they have lots of other investments besides real estate. But in the case of Henderson and Cheung Kong, primarily they're in commercial real estate. So they own office buildings, retail malls, and in the case of Cheung Kong, have a substantial interest in ports. So these are multifaceted real estate companies. They have a small component, Cheung Kong does, to residential real estate, but they're in prime locations in major cities where issues that were written about in today's paper, if we're talking about that, really aren't factoring into their particular companies. In fact, their residential sales for their projects in Hong Kong primarily, and then in the cities in mainland China, are going fantastic. As they've just reported to us, because we were over there visiting them a couple of weeks ago, they're moving on all cylinders. So our particular companies, sort of like what's going on here in Manhattan. In the same Wall Street Journal today was an article about how Manhattan real estate is sort of going crazy again. And that's true for the companies that we're invested in. The locations where they're at and the properties that they control are having great sales activity, best as they've reported to us in their history. So again, looking at individual securities, we're having positive experiences. Read the macro, big picture, what everyone wants to talk about, you know, sort of these stories are, they're, you know, a little misleading, if you will.
Well, I am curious, though, I mean, because if you talk about the real estate situation here in the U.S. and where we were going into the financial crisis, I mean, obviously it wasn't 100% every company out there is terrible, but when the crisis happened, it took everybody down pretty much, and that was whether you were in residential or other types of real estate or the banks or whatever, what have you. So what's the risk here that you do have a residential bubble pop and then it drags down some of these other types of companies?
Yeah, and that's obviously, that risk exists and it will always exist. And now, as we saw in our own financial crisis here, it happened to even the best of best companies, right? Their stock prices performed poorly, but over a near-term period. And we're long-term investors. We're not trying to pick markets and times to enter and exit markets. We're just trying to find great values and then hold on long-term and generate capital appreciation and long-term return for our shareholders. So in our cases, it's possible that these securities might get affected by some kind of macro bubble blow-up. But over the long term, we think they're going to actually excel, because with their balance sheets, they can take advantage of these weaker players and possibly be strategic when that kind of thing happens.
All right, we were just talking about China. I said we're going to come to our backyard. We're talking about Yankee Stadium, which, of course, when they built, it needed a parking lot. So enter a municipal bond to fund that parking lot. And that bond, it's had a little trouble, right?
Yeah, so, you know, taking a step back again, we're opportunistic investors. We're kind of looking everywhere for places to invest and put our clients' capital to work. In this particular case, it's our Focus Credit Fund, and it's concentrated in the way in which it invests, and municipal obligations are something that's received a lot of attention. There's been some calls for massive defaults in those securities, and as a result, some interesting situations are arising, and they are, as you said, right in our backyard. So this is a particular situation where, as part of the Yankee Stadium rebuild, a bond was floated to help finance the renovation and creation of a couple more parking spaces for Yankee Stadium. It was done at a time when attendance was way up, the economy was strong. As everyone remembers, the Yankee Stadium construction project was conceived well before the financial crisis hit us, and that has impacted some of those initial forecasts and assumptions that went into the creation of that security. So as a result of what's gone on and just attendance at the games and the fact that there are other ways for people to now get to Yankee Stadium. Metro North built a railroad stop there, which has really taken away a bunch of passengers, or attendees rather. And so there's an opportunity in these particular securities because the price of those bonds has come down. So and we are very price conscious in the way we invest.
I'm curious, though, I mean, what's going to make them go back up? Are you a little more sanguine on what the driving attendance numbers are going to be? Is it just a matter that it was oversold because a lot of people were getting out of the municipal market? I mean, what's going to change that will improve the price?
Well, so there are a couple things that can change, that should change. For one, this was a deal that was done in a structure at a time, again, with certain assumptions that haven't come to pass. So there's got to be potentially some operating changes to the way in which this bond was structured. The development authority that issued the bonds, which is a governmental entity, obviously creating the municipal obligation, could do something to shore up the entity so that its capital position is a little stronger, and that could help improve the price of the bonds. The marketplace could improve. Obviously, an improving economy could improve the price of the bonds. People could start coming to games in the way in which they came to the games before. The Yankees could start winning. That would help. The Boston series, in which they bring in a lot of people, it hasn't been great the last couple of days. But there are a combination of things that could happen. But if none of them do, the way we invest in every security that we own, we always sort of look down before we look up. And if the situation became dire and there was an actual default, something we think is not a likely scenario, but something that we obviously analyze, then it would be a very interesting situation, because then you own some pretty attractive real estate that is around Yankee Stadium, which obviously, whether it draws 3 million, 4 million, or 2 million fans to the games, it still attracts people to that area.
I want to talk about another investment that for many might be counterintuitive, and it's another debt situation, and it's Lehman Brothers, which many people don't even think about anymore in terms of owning, but a lot of people out there actually do own the debt right now. So talk to me about how this is structured, where it is price-wise, and what could potentially happen.
Sure. So everyone knows what happened to Lehman Brothers, and they had a very, very sizable balance sheet at the time of their demise, and those obligations, unsecured obligations, traded significantly down and ultimately started becoming acquired by a bunch of investors like us, and some acquired a lot of them, and we've been pretty careful about the way we've accumulated a position in these securities, but started buying in the high teens or low 20s cents on the dollar. Not long after that we acquired these securities, the company that's now Lehman, the CEO of that company and the company running it, Alvarez Marsal, filed a plan of reorganization saying they want to get the company out of Chapter 11 and they want to distribute to creditors the proceeds that they've generated from liquidating all of Lehman. Because clearly Lehman is not a reorganization per se, it's a managed liquidation.
Right. And so have you gotten payouts then?
So the payouts,
just quickly here.
The payouts haven't started yet, and they're hoping to get a plan that will be approved by the court that will initiate payments, and then hopefully the price we've paid for those bonds will be a lot less than the ultimate proceeds we receive.
All right, David Barse, Third Avenue Management, thank you so much for coming in. Good to see you to talk about distressed opportunities.